Okay. Okay. Good morning, everyone. Welcome back to our second day on Ind AS 33 that deals with earnings per share. In the previous class, we had discussed the concept of earnings per share, why it is an important why it is an important indicator, and how it kind of forms a bridge between the financial statements and the market price using the help of something known as the PE multiple. Then we moved on to discuss what is basic EPS, which is nothing but net profit attributable to equity shareholders upon weighted average number of shares. And after that, we proceeded to calculate the weighted average number of equity shares through various examples. Okay, weighted average means you are weighting it for the time. You are keeping time as the weighing factor. Because why we are taking time as the weighing factor? Because time represents the period the capital was actually invested in the company, and that is why time would be an accurate representation to weigh the number of equity shares. Okay, so this was the basic concept. Then we moved on to calculate EPS in the case of bonus. In the case of bonus, we also saw that bonus is the presence of what you can say free equity shares already in the capital structure. They are present but not as equity but as reserves. And that is why when you do a bonus calculation, an EPS in the event of a bonus, we not only calculate for the current period, but we also restate the EPS for the previous period. Okay, so we have seen that we don't go and alter the annual report of the last period. Instead, in the current year's annual report, previous year columns, we make the adjustment for the bonus also in that. Okay, so we had concluded up till this part. If you are able to remember, I had left you with two things. One is I had explained to you the impact of bonus on market price. The market price is typically going to be adjusted proportionately in the ratio of bonus. So we discussed in an ad hoc example, suppose Reliance issues bonus shares. Before the bonus, the market price is 2,800. So suppose you are holding one share of Reliance, it is worth 2,800. Now when Reliance gives you another bonus share, okay, another share for bonus, that means you will now have two shares for the price of 2,800. That is, the price will immediately drop down to 1,400. This actually happens. Okay, this actually happens. Whenever there is a bonus share, the price will fall down. Now, because of this 1:1 split, we had also calculated something known as a bonus adjustment factor. This bonus adjustment factor was calculated as number of shares after bonus divided by number of shares pre-bonus. So I had one share before. After the bonus, I got another share. After the bonus issue, I had another share. So now I'm having two shares as compared to one bonus share earlier. Okay. Then we move on to the market price ratio. Pre-bonus is 2,800. Post-bonus is 1,400. Okay. So pre-bonus, can I say now, please pay attention. What I'm talking now has a very, very important relationship with the respect to the rights relationship. Okay. That we are going to discuss shortly. Okay. Can I say that the fact that I have one bonus share gives me the right to get another bonus share? Absolutely. The fact that I have one bonus share gives me the right to get another bonus share. That means today, if I have one share worth 2,800, it is not just the share price. The bonus is declared by the company, but it is yet to get credited to my demat account. So as on today, I am having a bonus. I am having the share plus right to bonus. Okay. So can I say that this 2,800 is a cum bonus price, Cum means including the bonus component, divided by post-bonus. The post-bonus component means bonus is issued and now I got 2 shares in my demat account. So each share is worth 1,400. This is excluding the bonus component. On this share of 1,400 now, I'll not get any bonus because bonus is already credited. The right to get the bonus is already extinguished once the company declares the bonus. So this is my X bonus price. This is my X bonus price. All right. So therefore, we have learned now that there is something known as a cum bonus divided by X bonus price. Okay. And this is an accurate representation of the bonus adjustment factor, Okay. So this is broadly what we would have learned in your bonus. Okay. So we've kind of revised what we have done. Now we move on to the next concept. Yeah. Sairam, I have told you ICAI annual report. So I'll be discussing in detail that case study once your understanding of rights issue is clear. Okay. Once your understanding is clear, but I had told you to just have a look at it. So we will discuss that once we complete the discussion on rights issue. Okay. So now we come on to the next important part, that is rights issue. So bonus is clear. In bonus, you will have to remember for the purpose of rights issue, this thing. That is the cum bonus divided by X bonus price also is a representative of the bonus adjustment factor. Okay. So just remember this in mind and then we shall proceed further. For the purpose of rights issue, I will discuss it with the help of an example. That example should fairly sort out your doubts about rights issue. Okay. So this is from your study module. At 31st December 20X1, the issued share capital of a company consisted of 1.8 million ordinary shares. 1.8 million means 18 lakh shares of rupees 10 each fully paid. The profits for the year ended 31st December 20X1 and 31st December 20X2 amounted to 6,30,000 and 8,75,000 respectively. On 31st March 20X2, the company made a rights issue on a 1-for-4 basis at rupees 30. That means you are getting the right to exercise the right share. Okay. You are getting a right to subscribe to the right share. At what price? At rupees 30. The market price of the shares immediately before the rights issue was rupees 60. So now what you have to do, you have to calculate the EPS. Okay. So what I'm going to do is I'll solve this question by 2 ways. One is I will explain the concept in detail, what happens in a rights issue right now. That you need not do it in the exam. Then I will solve it by the second way where I will explain how it has to be solved in the exam. In the exam, you do the second way, but the concept is what drives the methodology that you will follow in the second method of solving. Okay. So now let us come to this question. Okay. This is question number 6, if I am not mistaken. Okay. So Kumar Mangalam. Yes. So you had a question in December 2021 attempt regarding continuing and discontinued businesses with relation to EPS. Can you please explain the idea about EPS in this case? We'll come to that. There is a control number concept that is introduced in Ind AS 33. So maybe in the next class, I would be discussing it. Okay. But it is an important concept. So we'll be discussing that. All right. So now coming to illustration 6. Yes. So now let us start. What is your capital structure right now? 31st December 20X1. 31st December 20X1. 31st December 20X2. These are the 2 financial years. Number of equity shares. Number of equity shares is 18 lakhs. 18 lakh shares already. Okay. Profits for the year 6 lakh 30, 8 lakh 75,000. Profits 6 lakh 30,000 and 6 lakh 75,000. Okay. Here also you will definitely have the basic number of equity shares. All right. Next one. On 31st March 20X2, the company made a rights issue on a 1-for-4 basis. So rights issue. When is it made? It is made in year 20X2. Okay. 20X1. So here rights ratio is 1:4. That is, for every 4 shares which you are holding, you are going to get 1 share. So that means you are holding 18 lakh shares. So 18 lakhs divided by 4, that is 4,50,000 shares. 4,50,000 shares at rupees 30. All right. The market price of the shares immediately before the rights issue was rupees 60. Market price rupees 60 before rights issue. Okay. So this is what is the facts given in the question. Now we will have to calculate the basic EPS and the diluted EPS. You will say, sir, what is the big deal? Basic EPS for 20X1 is calculated as rupees 6,30,000 divided by 18 lakh shares. So that is equal to 6,30,000 divided by 18 lakh shares. This comes to rupees 0.35. This comes to rupees 0.35. Fair enough? Yes. So therefore, rupees 0.35 per share. All right. This is the first thing that you are going to do. Okay. The next one that you will tell me is, sir, basic EPS for 20X2. Sir, what is the big deal? We can calculate this as under. Vains we'll have to calculate. So when we have to calculate vains, it is going to be, sir, 18 lakh shares were there for entire 12 months period, and the right shares came into existence on 31st March. Okay, 1:4 on what is the date? 31st March 20X2. 31st March X2, right? So this is the date when you have the rights issue. So March X2 means till 31st March. So 3 months have gone. So 9/12 into 9/12. And then you proceed to calculate. Into 9/12 plus 18 lakhs. So your number of shares will be 21,37,500 shares, right? And then you proceed to calculate EPS. Basic EPS is equal to earnings kitna hai? Earnings is 6,75,000. So 6,75,000 divided by 21,37,500. So 675,000, 21,37,500. We are getting rupees 0.315789 per share. We are getting this. Okay. So this is your basic EPS. Is this correct? Is this correct? This basic EPS, is this correct? Is my first question to you. If it is not correct, what is the reason behind it not being correct? Okay. So what do you think is probably missing in this? Okay. I don't want you to give me the right answer as such, but if you can just identify why this method is wrong. Okay. Why we cannot do it directly like this. Okay. So just let me know. Come on. 6 lakh or 8 lakh? What is the profit? Sorry, 8,75,000. Aditya, be careful. 8,75,000. So 875,000 divided by 21,37,500. Yes. This is 0.409357 per share. Okay. So now you tell me if this is not correct, why it is not correct. I'm waiting for your answers. Okay, I'm waiting for your answers. Because of share price, full amount is not received on the right shares as was received on previous shares. That is Sheena Jain's price answer. And Sairam is also saying because of the share price. Absolutely right. See, what is happening is these extra 4,50,000 shares which came in your capital structure, these 4,50,000 shares is not happening at market price. It's not happening at market price. It is happening at a price below the market price. Okay. That means I'm not getting the exact fair value of my shares. I'm not getting the exact fair value of my shares. In all the previous questions, when we did weighted average number of equity shares, we were calculating in this manner because I was issuing the shares at fair value. I was issuing the shares at fair value. In this case, this is the issue of shares that is happening at a price below the market price. Why? Because it is happening to existing shareholders. And that is why I cannot take this because there is a bonus component in this. Bonus component exists. That's right, Tanushri. Bonus component exists in 4,50,000 shares. And that is why we cannot do a plain vanilla calculation as 18 lakh shares into 12 by 12 plus 4,50,000 into 9 by 12. We cannot. It is ignoring the bonus component that is present in the rights issue, and therefore this answer is wrong. Now, how do you calculate the bonus component in the rights issue? How do you calculate the bonus component in the rights issue? Okay. So now, number of shares issued as rights share shares is equal to 4,50,000 shares is equal to 4,50,000 shares. All right. Now, therefore, proceeds raised is equal to 4,50,000 shares multiplied by what is the issue price? Rights issue is rupees 30 per share. No doubt about that. So the proceeds that you are raising is rupees 135 lakhs. That is 1 crore 35 lakhs. Okay. So this is the proceeds that you are raising. But for 1 crore 35 lakhs, are you raising it at fair value? No, you are not. The fair value is something different. You are raising it at a price below the fair value. You are raising it at a price below the fair value. What is the fair value, sir? Fair value is equal to market price is equal to rupees 60 per share, and you will proceed to calculate as the rights issue at fair value being 1 crore 35 lakhs divided by 60. So that comes to 2,25,000. Now you will say that 2,25,000 is the bonus component, 2,25,000 is the fair value component. It's the fair value component, and accordingly you will proceed to calculate, and the answer to that is again no. The answer to that is again no. This fair value, I cannot give this statement. I cannot give this statement. Why? Because this market price of 60 rupees per share is entitling the holder to one share, or what I can say is whatever share he is having, let us take it as one share, plus for every 4 shares held, he is entitled to another right share, to subscribe the right share at a discount. So this 60 rupees per share price is a combination of one share at the fair value plus the right to subscribe to right shares. The right to subscribe to right shares. You can look at the wordings given in the question. The market price of the shares immediately before the rights issue was rupees 60. That means what? In this 60 rupees ka jo price hai, in this price, I am having the share, the worth of the share plus the worth of the right, plus the worth of the right. And therefore, what am I going to do now? I am going to record, I am going to separate it. I am going to separate this. How am I going to separate it? This, can I say, this market price is the share plus the right. So can I say that this is the cum rights price? Can I say that this is the cum rights price? Yes. It includes the right to subscribe to additional shares at rupees 30 per share. So this becomes a cum rights price. Okay. So now what the standard tells us is, if you have a rights issue, the step that you will calculate is something known as the theoretical X rights price. Theoretical X rights price. What is my theoretical X rights price? It is nothing but the market capitalization immediately before the rights issue. Immediately before the rights issue, plus the proceeds that you are going to get. That is the worth of your company, divided by the number of shares that will exist after the rights issue has happened. Sir, come again. Let us do it with numbers. You had how many shares? Well, I had 18 lakh shares, right? I had 18 lakh shares. Each share is worth rupees 60. Each share is worth rupees 60. So this becomes your market cap of the company immediately before the rights issue is exercised. Plus, on the exercise of rights issue, you are getting 4,50,000 shares into rupees 30. This is the proceeds. So can I say that this is a fair representation of the worth of the company just when the rights issue concludes? Sir, why do you say so? Because the market cap of your company is 18 lakhs into 60. And then you are adding the cash that is flowing to it. You are adding the cash that is flowing to it. There is no other change that happens, no other event that happens. So this kind of becomes your theoretical worth of the company divided by what are the number of shares which will remain after the rights are exercised. This is 18 lakh shares plus 4,50,000 shares plus 4,50,000 shares. You can do it like this on a cumulative company, what you can say, entire company or entire organization basis, or you can also do it as each holder of 4 shares worth rupees 60 is going to get 1 share worth rupees 30. He has to pay 30. So for his holding, he will pay 30 rupees for the additional share that he is subscribing. And once he subscribes, how many shares will he have left? 4 shares plus 1 share. So whatever method you do, आपका आंसर क्या आएगा? Your answer will come as rupees 54 per share. Your answer will come as rupees 54 per share. What is this 54 per share? This 54 per share is the worth of your share without the right, the worth of your share without the right. Okay. So in other words, market price is equal to rupees 60 per share. Market price is equal to rupees 60 per share, which I also said is my cum rights price. Why cum rights price? When you hold a share worth 60 rupees, it is giving you the right to subscribe to additional shares at a discount. Okay. And then I'm having X rights price. After the rights issue would be done, the right is extinguished. So it becomes an X rights price, rupees 54 per share. You remember in AS 13, in investment accounts, you used to calculate profit made on sale of rights, not right shares, profit made on sale of rights. So you used to calculate the cost of the right. So in this case, cum rights is 60, X rights is 54. Therefore, value of the right is rupees 60 minus rupees 54. That is equal to rupees 6. Have you understood this part? Yes. Have you understood this part? I'm still not yet come to the calculation. I'm busy making you understand the concepts which are involved. Now let us proceed to another alternative to calculate this 6 rupees. Okay. See, market price is 60. Right shares issue, price of right shares issue is 30. So you are getting a discount of rupees 30. Now, this discount you are getting because you are holding already 4 shares and you are now subscribing to another 1 share. So rupees 30 divided by 5 is equal to rupees 6 per share is the discount that you are going to get, which is exactly this figure of rupees 6 per share, Okay. So in a nutshell, if I have to explain the concept of a right, today when the share is quoting at 60, it is worth not only the share price, but also the right to get additional shares at a discount. What will be the discount? It is rupees 30. But is it 30 for 1 share? No, it is 30 over the entire holding of 5 shares. So 30 divided by 5 is rupees 6 per share. Alternatively, you can calculate it as the X rights price, which is 18 lakhs into rupees 60 plus 4 lakh 50 additional shares that are going to be subscribed plus rupees 30 divided by total shareholding. So this is the numerator, which is the market cap immediately upon exercising the rights, divided by number of shares immediately after the rights are exercised. So this becomes your X rights price, rupees 54. And now I will take you back before that. So ये हो गया, वो सब तो ठीक है sir, but you have been telling that there is a bonus component in this. Where is the bonus component? अपने को तो नहीं दिख रहा. I am not able to see it clearly. In the case of bonus shares, I had a bonus component which was visible. Bonus ratio is 1:1. Here that is not given to you. The bonus component is hidden in the fact that you are getting the right to subscribe the shares at a price lower than the market price. And therefore, when I did bonus to you, I told you that the cum bonus price upon the X bonus price is an accurate representation of the bonus adjustment factor, is an accurate representation of your bonus adjustment factor. And that is why I will take the same discussion and come to the conclusion that the bonus adjustment factor in the rights component is going to be the cum rights price, which in our example is rupees 60, divided by the X rights price, which in our example is going to be rupees 54. Okay. So therefore, that was the bonus adjustment factor. Now this is going to be the rights adjustment factor. The rights adjustment factor is going to be rupees 60. The cum rights price, it was the cum bonus price there of 2,800. Here the cum rights price is rupees 60 divided by rupees 54. That is the X rights price. That is the X rights price. There it was the X bonus price of rupees 1,400. So this comes to 10 by 9. This comes to 10 by 9. If at all you are writing the decimals, it will be a recurring decimal of 1.1111 and it will continue so on and so forth. And it will continue so on and so forth. All right. So now let us proceed to check what is the bonus component that is hidden here. What is the bonus component that is hidden here? I take you back to this calculation. The total proceeds raised is equal to rupees 135 lakhs. 135 lakhs divided by the fair value of the share. Be careful, I'm saying fair value of the share, not the market price, because market price includes share plus right. So the fair value of the share is not worth 60, it is worth rupees 54 per share. It is worth rupees 54 per share. And therefore, what is going to be the what you can say number of shares at fair value? 2,50,000 shares at fair value. At fair value. Therefore, bonus component is equal to 4,50,000 is the total shares that have been issued, out of which 2,50,000 shares are at fair value. So this 2 lakh shares is the bonus component. This 2 lakh shares is the bonus component. Have you understood this so far? Have you understood this so far? Yes. Have you understood this? Any doubts so far? Any doubts so far? Anybody has any doubts in how we determined the bonus component? Yes. No doubt. All right. So now let us proceed to calculate the weighted average number of shares. Second. Yes. This is on 1st January 20x2, 31st December 20x2, and the rights issue happens on 31st March 20x2. So here I had 18 lakh shares. Here I had 18 lakh shares. Okay. Here I had 18 lakh shares. All right. This is a 3-month period. This is a 9-month period. Okay. So therefore, fair value is not equal to market price because the market price is giving you the worth of that one share plus the right to subscribe to additional shares at a discount. So that market price of 60 जो है, वो जो market price है, वो रहता है आपका दो चीजों का allotment. एक तो जो आपके पास शेयर है वो है, और दूसरा आपको एडिशनल शेयर्स मिलेंगे डिस्काउंट पे. तो वो जो राइट है दैट इज इंक्लूडेड इन योर मार्केट प्राइस. ठीक है. सो दैट इज व्हाई वी आर गोइंग टू कैलकुलेट, दैट इज व्हाई वी आर गोइंग टू से दैट द मार्केट वैल्यू ऑफ ईच शेयर will not be equal to the fair value of the share alone, because they are having a right that is embedded in the share price. They are having a right which is embedded. वो right का value उस share के साथ जुड़ा हुआ है. तो जो 60 रुपीस मार्केट प्राइस है उसमें आपको मिलेंगे शेयर भी और राइट भी मिलेगा. राइट शेयर नहीं, राइट मिलेगा शेयर्स को खरीदने के लिए एट अ डिस्काउंट. ओके, ठीक है. सो जय, दैट इज द आंसर टू योर क्वेरी. ओके, तो यहां पे ऑन 1st Jan 20X2 you had 18 lakh shares. You had 18 lakh shares. Now you remember what we used to do in the case of bonus. We used to multiply the bonus adjustment factor with whatever shares are in existence, prior to the date of bonus, and adjust it for time. We used to do that, and later on we would include it in the calculation normally. Okay, bonus date पे जो shares issue होते थे, we would not include that to multiply it with the bonus adjustment factor. So the same concept applies here. Only thing is, instead of bonus adjustment factor, we call it as a rights adjustment factor. So 18 lakh shares were there in existence before the rights issue. So I will multiply this by the rights entitlement factor or rights adjustment factor, multiplied by number of months is 3 by 12. Number of months is 3 by 12. So this is 18 lakhs into 10 by 9 into 3 by 12 plus I am getting how many shares for this? 4,50,000. So my total shares here is going to be 22,50,000. So this is going to be 22,50,000 shares into 9 by 12 into 9 by 12. Straightforward answer. Okay. All right. So this is going to give me 18 lakhs into 10 by 9 into 10 by 9. This actually gives you 20 lakh shares. What is this 20? 18 lakh that is already in issue plus the 2 lakh bonus component. What is this 22 lakh 50? 18 lakh already in existence plus 2 lakh the bonus component plus 2 lakh 50 at fair value, So 18 lakhs into 10 by 9 into 3 by 12. This gives you 20 lakhs into 3 by 12. So that is 5 lakhs. And 22,50,000 into 9 by 12, 16,87,500. So 5 lakhs plus 16,87,500. So 21,87,500 shares. Therefore, basic EPS is equal to, this is for 20X2. Rupees 8,75,000 divided by 21,87,500 shares. So this is going to be rupees 0.40 per share. 0.40 per share. Okay. And then I am having basic EPS is done. 20x2. 20x1. What was the reported EPS? 0.35 per share was my reported EPS. Okay. Therefore, 20x1 restated EPS. Remember, apply the bonus adjustment factor to all periods before the issue of bonus. Apply the rights adjustment factor to all the periods before the rights. So 10 by 9 is the rights entitlement or rights adjustment factor. So 10 by 9 into 18 lakhs gives you 20, which is nothing but 18 lakhs already held plus 2 lakhs bonus. So 18 plus 2, 20 will be there for all the shares in the capital structure prior to 31st March. So therefore, even for 20x1, you will adjust. So therefore, this is going to be rupees 6,30,000 divided by 18 lakh shares into 10 by 9. So that comes to rupees 0.315 per share. ये कौन सा है? This is my restated EPS. Yes, Jay, applying the adjustment factor for first 3 months is based on the concept of earliest reporting period. Absolutely right. Not only that, I am also applying it to the previous period also, to 20x1 also. Okay. So earliest reporting period was 31st December 20x1. So right from 1st January 20x1, I have applied it. Okay. What is the rights adjustment factor? It is basically the bonus component which is there present in your rights issue. Have you understood the computation? So my final answers are basic EPS 0.40, reported EPS of X1 is 0.35 and the restated EPS is 0.315 per share. So these are your final answers. Is it okay? Have you understood in detail about rights issue? Anybody has any doubts, any queries, anything relating to the concept? Okay. Yes or no? Tanushri, Sheena Jain, Priya, Sai Ram, सब समझ में आ गया आपको? Have you understood everything? Yes. ये तो हो गया concept. This was the concept. How to solve it in exam? In exam, it is you don't have to think so much. Okay, there are 3 to 4 steps. Follow those steps, and you are done with the presentation for your examination. All clear? Okay. So the actual method will happen like this. Okay, presentation for examination. You don't have to calculate all these things which I have just now explained. It is going to be a plain, simple presentation. Okay. Reported basic EPS for 20x1 is equal to rupees 6,30,000 divided by 18 lakh shares is equal to rupees 0.35 per share. Okay. Next, what are you going to do? Market price before rights is equal to rupees 60 per share. Rights issue price is equal to rupees 30 per share. Rights ratio is equal to rupees, 1:4. Therefore, theoretical X rights price is equal to, fair value will obviously fall after the right issue. Hai na yaar? It has to fall. Okay. Because you are having more shares at a lower price. Yes. So fair value will fall. How it fell down in the case of Reliance question, 2,800 became 1,400. Okay. Value utna hi hai. The number of shares increases in the denominator. So X rights price is equal to, you can do it by any method in the exam. 18 lakh shares into rupees 60 plus 4,50,000 shares into rupees 30 divided by 18 lakh shares plus 4,50,000 shares. Or any method, don't have to do both. I am giving you an example, that's it. 4 shares into rupees 60 plus 1 share into rupees 30 divided by 4 shares plus 1 share. So that is equal to rupees 54 per share. So this is the next step. So we have calculated the basic EPS that is reported. We have calculated the theoretical X rights price. Okay. So just copy this fast. I'll give you a minute. Okay. All right. So let us then proceed. Therefore, rights adjustment factor is equal to price before rights, or what you can call it as cum right price. This whole thing divided by price after rights. That is X rights price. So this is equal to rupees 60 by 54. So that is 10 by 9. If you are taking decimals, please take the entire figure. Okay. Reason is simple. See, it is a recurring decimal. So the chances that you will get a round figure when you do the EPS calculations are very high. Okay. If you just take 1.11, your answers will slightly go haywire because of rounding off. Okay. Or just keep it in fractions. That is even safer. Okay. So now basic EPS 20x2 is equal to rupees 8,75,000 divided by, how did I calculate the vains? Well, I had 18 lakh shares multiply by rights adjustment factor for a period of 3 months plus 22,50,000 into 9 by 12. So that is going to give you rupees कितना मिलता है 0.40 per share. This you can just note down. Alternative calculation of vains. I can take it like this. 18 lakh shares adjusted for the rights were in existence for entire 12 months. So the 2 lakh component has come entire. 18 lakh into 10 by 9 is 20. So 18 becoming 20 means the bonus component has already been adjusted for the entire year, plus 2,50,000 shares into 9 by 12. You can do it in this way also. That should also give you the same weighted average number of equity shares. Okay. But can you stop here? No, you cannot. You will have to restate. So restated basic EPS 20x1 rupees 6,30,000 divided by 18 lakh shares into 10 by 9. So that gives you rupees 0.315 per share. And that should give you the answer for your examination purposes. All clear? Yes. अरे अपने को सब समझ में आया कि नहीं? Bonus, it is taken no for 12 months for 20x1. Answer same आएगा ना यार. Answer will be the same if you do 12 by 12. Yes or no? I think you're talking about 20x1, right? In this 9 by 12, the bonus is already there. 18 lakh existing, 2 lakh bonus, 2,50,000 at fair value. And here it is 20. So 2 lakhs is already there for the 3 months. 2 lakhs is also there for the 9 months. Alternative also 2 lakh was there for entire 12 months. 18 into 10 by 9 becomes 20. So 2 lakh bonus component is there. So 2 lakhs into 12 by 12 already considered. Balance 2,50,000 for 9 by 12. Okay. So that takes care of your exam presentation. So Priya, Garg, Tanushri, Agrahari, Sheena, Jain, Sairam, Gali. I hope I get your names pronunciation right. Okay. Yes. So I hope you have understood this part. Okay. So Jay has a question. Or a clarification. Why are rights and bonus taken from the original shares? Is it because no resources are coming? Yeah. In fact, I had told you that if I don't take from the original date, from the first earliest reported date, I will suffer a great degree of distortion in comparability. If you remember this example that we did, the net profit increased by 3.2 times, but in fact, my EPS dropped to 0.8. We had done this question in the last class. Okay. So therefore, bonus will be deemed to be in existence right from the earliest reporting period because increase is there in number of shares, but there is no change in resources. We've already discussed this. Okay. Okay. So, any doubts? Students, any doubts? Yes, Tanushri. 250,000 rights element is there only for 9. It is not rights element. It is the fair valued element. Okay. It is the fair value element that is there in your rights. Actually, the rights element is 450,000. Out of that, 2 lakh is bonus. Bonus is there for the entire period. Whereas 250,000 is the fair value that has come into existence for a 9-month period. So you can do it anyway. Okay. You can either present the answer in this fashion, the veins, or you can present it in this manner. The choice is yours. Okay. Yes. Good to go. Can I proceed further? I got a lot of clarifications. Yes. All right. Then I had given you something to go through. Okay. So let us just have a look at that. Okay. I had given you small homework. I think that you will now be able to understand how this has been applied in my real life. Okay. In practical, for all practical purposes. Okay. So just a minute. Where are my financials? ये एक तो इतना बड़ा बड़ा स्टेटमेंट होता है. Okay. So this is the profit and loss account for the year ended March 31, 2020. All right. The profit for the year was 1,244.67. 1,244.67. So for the time being, just please forget this part. Okay. Don't look at this. Don't look at this. Okay. So therefore, net profit attributable to equity shareholders. Dekho, I do not have the complete figures. So whatever information was available in public domain, I have kind of collated that and simplified this for you. Okay. But the exact rupee numbers, I am not having access to that. Okay. But I'm getting the answer that matches their calculations. So jo bhi error will be there. It will be in some rounding of paise. Okay. So we can kind of discount that. Because profit cannot be 70,000. It will be some figures. But वो मेरे पास नहीं है. Okay. So this is 1,244.67 million. Okay. So therefore, the basic EPS, which is the reported figure. Let me try to maximize this for you. Okay. Is 1,244.67 into 1 million. Okay, so that comes to units 10,000, 10,000, lakhs, 10 lakhs, crore, 10 crore, 124 crore, 46 lakhs. Okay, and then if you look at this notes that are there, in the notes, the number of shares are also given. The number of shares are also given. Each share is worth ₹2. Each share is worth ₹2. So that will come to this share of 57,15,69,414. So therefore, my basic EPS is 2.18. In fact, this data is also given in the notes forming part of the accounts. In the notes forming part of the accounts, 1 second, let me search it for you. Yes, you can have a look at this. Basic EPS is based on the profit attributable to equity holders divided by this. So that gives you 2.18. That gives you 2.18. This was the story of 2020. This was the story of the year ending 31st March 2020. Now, when you come to 2020-21, if you look at the annual report, I think I have marked it somewhere. Page number 63, somewhere they have explained. This is page number, 1 second. Page number 63 of annual report. Yes. You can have a look at this. Raising of capital by rights issue. During the year, the company has raised capital by issue of further shares to eligible equity shareholders on a rights basis in the ratio of 8 shares for every 85 shares held. So this is the rights ratio. You are holding 85 shares, you have the right to subscribe to additional 8 shares. These shares were issued at a price of rupees 65 per share. So issue price in our example, it was 30. Here it is rupees 65 per share. So the face value is 2 rupees. So therefore the premium is 63 per share. The company has therefore issued how many shares? 5,37,94,768 fully paid shares, aggregating to, this is just a multiplication, 3,496.66 million. Okay. And they have later on described why did they have to raise it. It was raised for repayment of loans from the banks. Trading permission was received, so on and so forth. Okay. So this is what is the data that is given to you. Okay. And then if you further read the notes that are forming part of the accounts, 1 second. Where is the balance sheet? Yes. Here is the balance sheet. You can check here. Changes in equity capital. There has been a rights issue. So therefore, that gives you the increased capital. And you can also find that my securities premium has gone up on account of rights issue. My securities premium has gone up on account of rights issue. And when you move on to note number 56, 1 second. $45. Yes. This is the complete detail. Letter of offer dated 21st September offered these many shares at a price of 65. The issue opened on 29th September. It closed on 13th October. So what is the price that you have to consider immediately before exercising? That is the price on 13th October. I have done the workings also for you. This they have later on told that it is oversubscribed, so on and so forth. So, and what they have told where the money has been applied. Okay, so they have repaid 2,800 million for borrowings, general purposes, issue expenses, total 3,496. So now we come to the actual facts. Okay, total number of shares is 57 crore 15 lakh 69,414. This is the rights issue. Even if you just multiply it by 8 by 85, you will get this figure of 5 crore 37,94,768. So closing number of shares is 62 crore 53 lakhs. you are having the rights timetable as under. Okay. The rights offer is opening on 29 September when the market price was 81.85. The rights offer is closing at 76.20. The allotment date is 20th October. The record date, the date on the register of members who were holding the shares on that day, they will be eligible for getting the right shares. And the date just prior to the record date is 22nd September 2020. So when you are issuing the right shares, simple entry is going to be bank account debit to equity capital to securities premium. These amounts we have already seen being added to my share capital and securities premium respectively. Now, which price am I going to take for the purpose of calculating the rights bonus component? It is going to be this price, 76.20. It is going to be this. Sir, why this price? Because this is the price immediately before exercise of rights. Rights offer closed on 13th October. That means after that rights cannot be exercised. Matlab rights, the last rights would have been exercised on 13th October. And just before that, what is going to be your price? It was 76.20. These market prices you can get from various sources. I took it from some Yahoo Finance or something. There may be a small paise ka difference. Money Control has 76.2025 or something. But it is just a data to make you understand the application of this standard. Okay. So let us move on to the next thing. The theoretical X rights price is 85 shares at 76.20 plus 8 shares at 65. This gives you 75.24. So your rights adjustment factor kya rahega? Value before exercising the rights divided by theoretical X rights price. So this is going to be my rights adjustment factor or the bonus component. In our question, it was 10/9 or 1.11. The same thing is there here. So if I have to calculate my weighted average number, remember the allotment has happened on 20th October 2020. Actually, they have told in the directors in the annual report. So note number 56, they said, so you are having the original shares from 1st April to 19th October, which is a period of 202 days. Adjustment factor is 1.01. Number of shares is 57. So you remember in our earlier question, we had calculated it as 18 lakhs into 10/9 into 3/12. So here the same thing is done here. Number of shares into number of shares corresponds to this 18 lakhs. Adjustment factor corresponds to this and number of days. So 202 by 365 corresponds to this. So you get weighted average number of 32 crore 3 lakhs. And then after that, what did we do? We did 22 lakh 50,000 into 9/12, if you remember. Okay. So therefore, this is 6253, which corresponds to 22 lakh 50. 9/12, 163. So when you do the multiplication, you will get 27 crore 92. And 59 lakh 96 will be your weighted average number of equity shares. So the reported EPS is going to be 343 crore 12 lakh 40,000 loss divided by 5996. So this is going to be the basic EPS for which year? 2021. But does this rights issue contain a bonus component? Yes, it does. Proceed from rights is so much. X rights price is 75.24. So what is issued at fair value I got? What is actually issued I got? So the bonus component is 7319,225. This bonus component ultimately gets added to the reported EPS wala veins, and there you are now going to restate the EPS to 2.15. If you look at the annual report, you can now check that, see, the number of shares in this case have become 57 crore 88 lakhs. Whereas when they were reported, the number of shares were 57 crore 15 lakh 69,414. Is it okay? So this is the net profit attributable for the current year 2021. We have factored that with the help of these equity shares. Okay. So that takes care of your EIH Limited's practical application of rights shares. Is it okay? Have you understood this right shares in detail? Yes. Have you understood this part? Any doubts? किसी को कोई doubt है? Yes. I had told you to just go through it, but I think you should now be in a position to better understand how rights issues actually happen and how is the treatment for the EPS thereunder. Okay. Market price immediately before the rights are exercised. If you look at the bare standard, it does not talk about, where is the appendix? Rights issue. You will take the fair value immediately before the exercise of rights. It's not talking about record date. It is talking immediately before the exercise of rights. Exercise of rights closes in our practical case on 13th October. So you will take that fair value. Okay. All right. समझ में आ गया अपने को? Yes. Academically, record date, exercise of rights, receiving the proceeds, everything happens on one day. In real life, it does not happen on one day. It happens, देखो 21st September they came out with the offer letter. The rights concluded on 13th October. The shares were allotted on 20th October. So it is spread over a month-long period. So you will have to apply the Ind AS accordingly. Okay? Right? In academics, it all happens on one day. But in practice, वो कभी नहीं होगा. It's not possible. Okay? Okay, so that takes care of this. I hope you learned something different. I thought this might help you out. Okay, so don't think that it was a time waste. Okay, वो थोड़ा सा practical application kind of adds little amount of fun to what we are studying. Okay, so that takes care of rights issue. Now what I'm going to do is I'm going to give this for homework. Okay, because we have discussed rights issue so much in detail that now even in your sleep you should be able to do these questions. Okay, I have discussed all possible permutations and combinations. Okay, this also I will be leaving it for homework. समझ में आ गया अपने को? Did we understand? Can you please do these questions for homework? Because doing the same thing again and again means वो repetitive हो जाता है. It will be a repetitive exercise. Today I don't see Srinidhi, I don't see Vidula. पता नहीं, where are these children? Okay, so will you please do these questions for me as homework? If you have any doubts, I will address it in the next session. But as of now, I think you should be able to do it. करोगे? Please tell me. I told you, which rate will we take while calculating the ex-right price? The date immediately before exercising. In our case, it was 13th October 2020. So you will be taking that rate, 76.2. Okay. Yes. Okay. So if I have to just summarize what we used to do in rights issue, compute the theoretical X rights fair value or price, compute the rights adjustment factor or the rights multiplier, restate all shares prior to the date of rights issue after multiplying with the rights adjustment factor, and then compute Waynes. We did it for our example that we solved. We multiplied 18 lakhs into 10 by 9 for 3 months for the current year as well as for the last entire year into 12 by 12. Compute the basic EPS for the current year and restate the EPS for the previous year. So that takes care of this. Then the standard further describes how to calculate the X rights fair value. You can take the base into fair value plus, this is before the rights are exercised, plus rights issue into rights issue price divided by base shares quantity plus right shares quantity. Or you can take fair value before the rights issue plus rights ratio into rights issue price divided by 1 plus rights ratio. Whatever it is, it's just a ratio computation. Adjustment factor is fair value prior to rights issue, that is cum rights, divided by theoretical X rights price. Okay, before rights issue exercised. Okay, divided by theoretical X rights price. So that closes our discussion once and for all on rights issue. Okay, all right. No problem, Vidula. I think you should be able to be in a position to view it, and you should be able to understand this. Okay, all right. Fine. So next one is related to buyback. This, I will leave it for homework. Reason being, buyback concept is exactly the same as rights. There was a rights adjustment factor in the case of rights issue. In the case of buyback, there is an buyback factor. There is a buyback factor. You are paying more to buy back the shares. Okay. So please solve it. I have already shared the solution to buyback also. Yes. So when I talk about buyback, it's going to be something like this. Okay. This is what is going to be the question on buyback. You will calculate X buyback fair value or price. Only thing is, it is going to be, there was a plus sign here because you used to subscribe to the shares in the case of rights issue. Yahan pe it is going to be a negative. It is going to be a negative. Why? Because now company is paying to remove the shares from the capital structure. So yahan pe and here also there is going to be a minus sign. So that gives you your X buyback fair value. Then you are having a buyback adjustment factor, and that kind of takes care of it. Okay. You should be able to understand the bonus component in a buyback also. I have given the whole detailed workings for you. So you should be able to understand the bonus component as well as calculations. Okay. So please do it. Please do it. It's simple. Based on same lines as rights issue. I have shared the solutions with you. I have shared the question also with you. Only thing is the difference is in plus and minus. That's it. Otherwise, it's entirely the same. If you have any doubts, I'm always reachable. But abhi ke liye, I will proceed further. Okay. So buyback is also same like rights issue. Okay. All right. Next one. So that takes care of rights issue for us. And then we shall proceed to, one second, here. Diluted EPS. We shall then proceed to diluted EPS. Acha. So abhi basic EPS is all done. We have discussed all the factors, all the aspects which are relevant for us. Okay. We have discussed weighted average number of equity shares. We have discussed what you can say, bonus shares. We have discussed right shares. Okay. Sorry, before that, before diluted, some important concepts. Okay. Denominator discuss kiya, basic EPS discuss kiya, rights discuss kiya, bonus discuss kiya. Just a couple of factors relating to the numerator in EPS calculation. Numerator in EPS calculation. Then we shall proceed to diluted EPS. Okay. अच्छा. What is the numerator? Sir, numerator का क्या है? Numerator is net profit attributable to equity shareholders. Net profit attributable to equity shareholders. Okay. ठीक है. So now, what do you mean by net profit attributable to equity shareholders? Is equal to net profit after tax minus preference dividend. Why do you deduct preference dividend? Well, you deduct preference dividend because the EPS is calculated from the perspective of the last person who has a residual interest in the net assets of the company. Okay. So that category of equity shares ke hisab se you are going to calculate the EPS, and that is why you are going to deduct preference dividend. This was the concept that you studied in AS20. This was the concept that you studied in AS20. However, in Ind AS, what do you do with preference shares? There are two possibilities. First one is preference shares could be financial liabilities. Preference shares could be financial liabilities. Sir, why financial liabilities? Well, suppose you had a preference shares that were redeemable, say after 20 or 30 years. In India, it has to be 20 years. So suppose they are redeemable after 20 years and there is a dividend rate of 10% that is prescribed. Now, these are mandatorily redeemable preference shares with dividend at the rate of say 10%. So now it appears that you have issued a share. But in reality, what have you issued? You have not issued shares. It is a loan that you have taken. Usko khali naam diya hai shares ka. Yes, but in substance, you are going to deliver cash in the future. You are going to pay the interest on that. And therefore, it is not a part of share capital. It is actually a financial liability. The dividend in this case would represent finance cost, which would already go and sit in your finance cost calculations, in your finance cost figures. And therefore, if that is the case, the net profit after tax is after deducting finance cost. अच्छा, कभी-कभी ऐसा होगा, sometimes you will have it that preference shares are issued and they would be redeemed at a premium. So how would you do the accounting as per your financial instruments chapter? Well, you would calculate something known as the effective interest rate. You would impute the effective interest rate in the amortization table of the financial liability. Every year you would take the effective interest rate, and that finance cost based on the effective interest rate would be charged to your profit and loss. And you would deduct any coupon payments that you would be making to arrive at the closing balance of the financial liability each year. And at the end of the tenure, the preference dividend liability, the preference capital liability would automatically be repaid off. So therefore, you are already calculating the finance cost based on effective interest rate, which is included in the finance cost charges of your P&L. So will you again deduct preference dividend? Answer is no, you will not. And therefore, you are going to record it as a part of finance cost. No further adjustments. adjustments to net profit after tax. Could this happen? Yes. Could also alternatively be equity. Could alternatively also be equity. Sir, equity kaise hoga? Well, look at the case. Redemption will not happen. It is irredeemable. And dividends are at the discretion of the company. So irredeemable plus dividends discretionary. Discretionary means when the company wants, that point of time, it will make the dividends payment. Okay. So therefore, when it is irredeemable, when it is having discretionary dividends, it is tending towards an equity instrument. It is tending towards an equity instrument. Therefore, will I have to now adjust my net profit after tax? Definitely. So net profit after tax minus preference dividend. Okay. Now, in this case, there are two possibilities that can happen. The first possibility is I could have cumulative preference shares, or I could have non-cumulative preference shares. What do you mean by cumulative? Yes, aapka padha hua, it's something which you've already studied. What do you mean by cumulative preference shares? Well, cumulative preference shares actually means that every year you have to provide for the dividend liability, regardless of whether you pay or not. Subsequently, when you pay the dividend, you have to ensure that the previous dividends are all paid off before you can pay the subsequent year's dividend. For example, year 1, you did not declare the dividend, but you have to provide for it. Year 2, you have not declared, but you have to provide for it. Year 3, when you decide to pay, you cannot pay year 3's dividend only. You will have to pay year 1, 2, 3, all of them put together in the third year. And therefore, in the case of cumulative dividend, you will have to deduct the dividend whether declared or not, because that is getting accumulated year on year. Whereas in the case of non-cumulative, you will deduct only if declared. Only if it is declared. Otherwise, you are not going to deduct the dividends. You remember the very first question that we did, that Mitra Limited. In that question, we had discussed cumulative as well as non-cumulative. वो छोटा सा discussion था. It was not a very huge discussion. It is something that you are already aware of it. Okay. Just for you to refresh your memories, we will just have a look at it. Yes. So net profit of Mitra Limited was 200 lakhs. Tax rate was 37%. Non-cumulative fully declared, cumulative fully provided. Okay. So this, we had done this question. So I think you should be able to understand it. Okay. We then come on to another concept known as increasing rate preference shares. Okay. What do you mean by increasing rate preference shares? It means these shares provide low initial dividend to compensate an entity for selling preference shares at a discount, or an above market dividend in later periods to compensate the investors for purchasing preference shares at a premium. Okay, so we shall look at this with the help of an example that I have kept for you. One minute. Yes. Let us check this with the help of an example. A company issued non-convertible, non-redeemable Class A cumulative preference shares. Non-convertible, non-redeemable Class A cumulative preference shares. Non-redeemable means वो equity हो गया. It becomes equity. Okay. Of rupees 100 par value at the beginning of year 1. these shares are entitled to a cumulative annual dividend of 7 rupees per share starting in year 4 at the time of issue. At the time of issue, the market rate dividend yield on such shares was 7% per year. You are required to compute the issue price and the treatment for computation of EPS. Okay. So now, अपने को क्या करना है? Understand, I have certain preference shares. I don't have the ability, the company does not have the ability to pay the dividends right from year 1. The company does not have the ability to pay the dividends right from year 1. So what does the company do? The company says, look, I don't have ability to give you dividend. Instead, I will issue the shares to you at a discount. That discount will make up for the dividend that I should have issued to you for the initial years. Later on, I will slowly increase my dividend. I will slowly increase my dividend and bring it at market levels. So that is what is increasing dividends. Okay. So if I have to plot my graph, the dividend initially is 0. Later on, it is 1%, 2%, 7%. So initially 0 and then the dividend rates start to increase. That means what? The company at some point of time is adjusting the issue price by issuing such shares at a discount. So what Ind AS 33 tells us is the discount that you are giving is not an actual discount. It is a compensation for the dividends that you are not giving in the first initial years. So what the standard tells, you discount the price using the market rate dividend yield, compute the issue price, and then you will do an EIR calculation every year until it reaches the par value that you have issued. And later on, the dividends will continue as they do normally. So let us look at the answer for this. 100 rupees par value is issued. Compute the issue price of the preference shares. Okay, compute the issue price. What they have told, these shares are entitled to cumulative dividend starting in year 4. That means 1, 2, 3, there is no dividend payable to them. There is no dividend that is payable to them. So therefore, aap kya karoge? You will give it at a discount. So how are you going to calculate the discount? Present value of rupees 100. Dekho, face value is 100. No shareholder will give you 100 because वो बोलेगा मेरे को तीन साल के लिए dividend नहीं मिल रहा. I'm not getting dividend for 3 years. So what the standard tells, issue to them at a discount. Discount it at the market rate dividend yield. These shares should fetch a 7% dividend yield in the market. So 100 rupees discounted at 7%, you will do an issue at 81.63. You will do an issue at 81.63. How did I get 81.63? 100 into 0.8162 something. What is this 0.8162? Present value factor at the rate of 7% for a period of 3 years. You can check it up. 1 divided by 1.07, 1.07, 1.07. 0.81629 you are going to get. That is 0.8163 effectively. Okay? So that means you are going to issue these shares at 81.63. So what is the journal entry? Journal entry on issue of shares. On issue of shares is equal to bank account debit 81.63 to preference share capital 100. What is this? 100 minus 81.63, 18.37. This is discount on issue. This is discount on issue, 18.37. What does the standard tell us? It tells us that Original issue discount on increasing rate preference shares is amortized to retained earnings using the effective interest method and treated as a preference dividend for the purposes of calculating EPS. So discount on issue, where will it go? This will go to my retained earnings. This will go to my retained earnings. Okay, it will appear under the retained earnings. The total other equity is there. You will show this as discount on issue appearing there. Later on, year one हो गया. Are you going to declare the dividend? No. But you've already issued it at a discount. So this dividend will start showing its form and this 18.37 will start to get amortized. So therefore, for the first year, the imputed dividend will be 5.71, which is 81.63 into 7%. So you will pass the entry. You will pass the entry like this. Year 1, year 2, year 3. You will pass the entry preference dividend account debit to discount on issue of preference shares. Kitna rahega? For the first year, that is going to be 5.71. 5.71. For the second year, it is going to be 6.11 and then 6.54. 6.11, 6.54. So for each year, the preference dividend will be calculated and ultimately this 18.37 will become 0 at end of year 3. And when you are calculating the net profit attributable to equity shareholders, it will be net profit after tax, whatever it is, minus preference dividend. These are non-redeemable. Okay, so it is equity. So you will deduct preference dividend. So that gives you 5.71, 6.11, 6.54. That will give you net profit attributable to equity shareholders. Okay, that will give you net profit attributable to equity shareholders, and then you proceed to do the calculation. After year 3 as it is. Have you understood this part? Yes. Increasing rate preference shares. Did you understand? Irrespective of whether such discount or premium debited or credited to securities premium. Have you understood this? Have you understood? Yes, increasing rate preference shares अपने को समझ में आ गया? Yes or no, boys and girls? Priya Garg, Tanushri. No, समझ में आ गया? See, these points which I have just now discussed, it is mentioned somewhere in your chapter, but ऐसा example नहीं दिया. It's not given as an example. I have put it based. Now see, this example which I just now discussed, this is there in the Ind AS 33 issued by the Ministry of Corporate Affairs. Okay. So यहाँ पे that example is there. So I have taken this example from there. ये example आपके study module में भी नहीं था. Neither was it there in the past papers. Okay. But I have kept it because kabhi na kabhi you can expect a question on this. So it is like an amortization of your financial liability. So that takes care of this. Okay. So Priya Garg has confirmed. Or koi, Sai Ram is there, Jay is there, Tanushri is there. Why are we guys not interacting? I feel मेरे को बोर लगता है अगर आप interact नहीं करते हो तो. Let me be very honest. Okay. Sheena Jain, are you there? Yes. Have you understood, guys? Yes. Priya Garg has confirmed. Please summarize if possible. Definitely it is possible यार, क्यों possible नहीं होगा? देखो, आपने शेयर्स इश्यू किए, कौन से शेयर्स? प्रेफरेंस शेयर्स इश्यू किए। टर्म्स एंड कंडीशंस क्या थे? टर्म्स एंड कंडीशंस थे कि आपको पहले 3 साल डिविडेंड नहीं मिलेगा, 4th ईयर ऑनवर्ड्स आपको डिविडेंड मिलेगा। तो शेयर होल्डर बोलेगा यार मैं तेरे को फुल प्राइस क्यों दूं, तू मेरे को 3 साल डिविडेंड ही नहीं दे रहा है। सो देयरफॉर issue will happen at a discount, okay, because the company is not paying dividend for 3 years. It will pay the dividend after the 4th year. So therefore par value pe to issue cannot happen. The issue cannot happen at par value. This is what is the presumption of the standard. So what the standard says, yaar tu discount kar, kis rate ke hisab se discount kar dega? Discount it at the market rate dividend yield. मतलब उस शेयर पे डिविडेंड कितना एक्सपेक्ट करता है? What is the expectation of the shareholder for dividends on that share? What is the market expectations? You will take that into consideration. So on those shares in this example, the expected dividend was 7%. ठीक है, तो I will discount it. तो यार तेरे को 7% चाहिए ना, मैं 7% डिस्काउंट करूंगा उसको. I will discount it to the present value. So 3 साल बाद डिविडेंड मिलेगा ना, तो I will discount it for 3 years. आज के तारीख में मेरा शेयर का वर्थ कितना रहेगा? 81.63. शेयर होल्डर विल टेल यार मैं तेरे को 100 का शेयर खरीदूंगा बट आई विल पे यू ओनली 81.63. ठीक है ना, तो बचा हुआ अमाउंट कहां जाएगा? दैट विल गो टू डिस्काउंट ऑन इश्यू ऑफ शेयर्स. ये डिस्काउंट P&L में नहीं जाएगा, इसको हम लोग फाइनेंशियल लायबिलिटी के जैसे हम लोग इसको अमोर्टाइज करेंगे. एवरी ईयर मेरा डिविडेंड 7% रहेगा. सो इन द फर्स्ट ईयर मेरा वैल्यू कितना था? 81.63. 7% ऐड करेंगे तो इट बिकम्स 5.71. देन next year it becomes 6.11 and then third year it becomes 6.54. You've not paid the dividend but you have given a discount that is converted into a preference dividend. Okay, so therefore kya hoga hamara? This discount on issue is ultimately going to be amortized over the 3-year period, and this will be treated as an equivalent to preference dividend. So the entry will be preference dividend to discount. End of 3 years, this account will become 0. End of 3 years, this discount on issue of preference shares is going to become 0. Okay. And then finally, each year, what are you going to do for treatment? Well, net profit, kuch to rahega aapka. From that, you will deduct preference dividend. From that, you will deduct preference dividend. कौन सा preference dividend? The imputed preference dividend. After year 4 and onwards, it is going to be a straight away 7 rupees per share calculation. Okay. So this kind of gives you your net profit attributable to equity shareholders, which is the numerator for the purpose of EPS calculation. ठीक है. So I hope that it is understood. Srinidhi, are you there? Yes, then please respond. Sheena Jain, hope it's clear. जय श्रीवास्तव, समरी दे दिया, शायद आपको समझ में आ गया होगा. ओके, यस, सबको समझ में आ गया. जय, डिड यू फॉलो? यस, आगे बढ़ते हैं. डिस्काउंट ऑन इश्यू क्लोज होता है ना. सी, discount was a debit balance. Every year you are passing preference dividend to discount on issue of preference shares. So देखो, credit is happening na. Here it is a debit balance. Here it is getting credited. right? So 5.71 plus 6.11 plus 6.54 gives you 18.37. You can check it for yourself. 5.71, 6.11, 6.54, 18.3637 वो rounding off के लिए रहेगा. So end of year 3, ultimately discount becomes 0 because every year it has been a part of your preference dividend calculated based on your, as if your effective interest rate calculations are done. Did you understand now? Okay. I think if preference shares are issued at discount, then to calculate net profit, we have to deduct imputed dividend. That is right, Vidula. So that is what I'm doing. Net profit minus preference dividend, net profit attributable to equity. But for this, you have to check two things. Your preference shares must be classified as equity. If it is a liability, the preference dividend would be following the EIR and it would be included in finance cost. So that would not be a plain, simple summarization like that. You will have to check in this case whether it is a preference share in the nature of equity. Preference share in the nature of equity. Okay. And then you would do the calculation the way we discussed. If it is a liability, the preference dividend would be just a coupon payment, whereas the interest charge would already be included in finance cost. Okay. But otherwise the summarization is right. Okay. Okay. Let us then move on to the next concept. Repurchase of preference shares at a premium. Okay. Early conversion of preference shares. Acha. There are some, I won't say mistakes, but some inconsistency here. Some inconsistency here. Now see, early redemption or conversion of preference shares at a premium. At a premium. Yes. Okay. That's right, Jay. That's right. Okay. Non-current liability nahi hoga. It goes in, sits in your other equity. Okay. It sits in your other equity. Okay. As a debit balance, which gradually becomes 0. Okay. Now, early redemption or conversion of preference shares at a premium. Now, this is the position as per Ind AS 109. As per Ind AS 109. Which is the correct position. Okay. Classified as equity. Classified as liability. Classified as liability. It could be either this or that. It cannot be both. So preference shares could be classified as an equity, could be classified as a liability. And you are redeeming it early or you are converting it at a premium. So if it is classified as equity, the excess amount that you are paying, that premium generally taken to securities premium account. You will adjust it against securities premium. If securities premium not available, the premium goes to retained earnings. The premium goes to retained earnings. Regardless of whether converted or redeemed. Whether converted or redeemed. This is important, regardless of whether converted or redeemed. Farak nahi padta. My shareholder may opt for taking it into a conversion or opt for a redemption? Yes. But if it is classified as equity, the premium would ultimately be taken to the securities premium or retained earnings. So what is this premium in effect? It is an additional payment that is made to the preference shareholder. Where did it go? Sir, it went in securities premium or it went in retained earnings. That means it is an additional payment that is made to a provider of capital other than the equity shareholder, other than the one who has a residual interest in the assets. Is it deducted in the net profit after tax figure? No. Kyun? Wo kahan gaya? It has gone in securities premium or retained earnings. So what is going to be your treatment? Deduct from net profit to arrive at net profit attributable to equity shareholders. Why are you going to deduct? It is not deducted in the P&L. It has gone and been adjusted against securities premium. So therefore, you will deduct. Sir, why will I deduct? It is like an excess payment that is being made to the holders of preference shares. Classified as equity. If it is classified as liability, premium paid regardless of converted or redeemed would be a finance cost. That means what? It would be included in the P&L. Therefore, already deducted while calculating net profit after tax. No further adjustments needed. Okay. So it's already deducted while calculating net profit after tax. No further adjustment is needed. That means jo figure hai aapka NPAT, that is the final figure. Is it okay? So this is the correct picture. Okay. Now, what is being done by the institute? And if you read the standard also, it appears so that early redemption / conversion. This is what is being done. Okay. In the problems also that we have, we can see this is as solved by ICAI. Now see, in the case of early redemption, premium usually taken to securities premium. Why? Guidance as per Companies Act 2013. Premium on redemption can be met out of securities premium. Therefore, deduct the same while calculating net profit attributable to equity shareholders. So what the institute thinks is early redemption, whether it is a financial liability, whether it is an equity, it is usually taken to securities premium, and therefore we will be deducting the same while calculating the net profit attributable to equity holders. Whereas the actual position that is there is premium paid would ultimately be decided where it will go, in finance cost or in premium. That would be decided by the broad classification of the instrument as a financial liability or as an equity. So this is what is Ind AS 109's contention, which is correct. So there is this small inconsistency, I would say, that exists because it is giving a blanket treatment by saying that whatever be the classification of your instrument, whether it is equity, whether it is liability, premium paid on early redemption will always go to securities premium, and therefore you have to deduct it in net profit attributable to equity. But what 109 says, if my share is classified as a financial liability, the premium would form a part of finance cost, which would already be considered when arriving at my net profit after tax. So no further adjustment is needed. That portion is what is getting ignored here. Okay. The next, what you can say, inconsistency happens in the case of early conversion. Early conversion pe no guidance in Companies Act 2013. Hence, take such premium on early conversion to finance cost. To finance cost. Take it to finance cost. Regardless of whether it is classified as equity or preference, you will take it to, regardless of whether it is classified as equity or liability, you will take it to finance cost. So what is going to be the implication of this? The implication of this is, therefore, no adjustment to be made as already deducted in net profit after tax calculation, as it is already deducted in net profit after tax calculation. So this is what is your treatment. Okay, that is prescribed. But when we spoke about dividends, what is the institute saying? If it is a financial liability, dividend goes in finance cost, no further adjustment. If it is equity, like irredeemable with discretionary dividends, then it is an equity. Treat it as preference dividend. Check for cumulative, non-cumulative. So therefore, the treatment in respect of dividends is consistent with Ind AS 109. The treatment in respect of early redemption or early conversion premiums is not in line with the Ind AS 109 principles. Okay. So that is the only inconsistency which I can see. What do we do in exam? Please do what the institute has done. Okay. Please do what is prescribed by the institute solutions. I will also be solving using the methodology adopted by the institute only. But frankly speaking, this inconsistency could have been avoided. Is it okay? Yes. So what do we do is we take a break now. Yes. And then after the session, after the break, we will look at some questions. And once we look at the questions, our doubts to a great extent should be addressed. And then we shall proceed to move on to diluted EPS, जो कि important है. I will complete diluted EPS some concepts today. Next class, we should complete diluted EPS with financial instruments and contingently issuable shares. That should close your chapter comfortably, hopefully, on Tuesday. Okay. So we take a 10-minute break now. 10 minute का break ले लेंगे. Yes. And let me know if you've understood or not. Okay, what we have discussed. Okay, fine. Take a break. Nisarg. Okay, fine. All right, guys. So welcome back. So I have just discussed what is the broad treatment that we are going to do. Okay, so basis that, let us now proceed to solve our calculation, our questions and any discussion that is there. Okay, so let us check this part. Repurchase of preference shares at a premium under a tender offer to the holders. Okay, so this amount is deducted in calculating profit or loss attributable to ordinary equity holders of the parent entity. Okay, basically you are repurchasing the preference shares before they're due date, so you are going to compensate them. So you can have a look at some of these small examples or questions. So now ABC Limited had issued preference shares of rupees 100 each 10 years ago. Now it buybacks the shares for rupees 120 each. Rupees 20 premium is charged to retained earnings. No amount is recorded in the statement of profit and loss for this transaction. Probably they would have classified it as equity and accordingly they would have done the treatment. Okay. So therefore they are recording it in the statement of profit and loss. So discuss the treatment of this. What are you going to do? For the purpose of EPS calculation, you will take net profit after tax, whatever comes, minus premium paid to preference shareholders 20. So that is going to give you net profit attributable to equity shareholders. Okay, so that is what is the treatment. All right, next. Treatment of certain items in the numerator, early conversion of preference shares may be induced to for favorable changes to original conversion terms. Excess would be deducted in calculating profit or loss to ordinary equity holders of the parent entity. Okay, same treatment. There is no change. So let us then proceed to read this question, application of it. Let us try to understand. Okay, now see, ABC Limited issues 9% preference shares of a fair value of rupees 10 each on 1st April 20X1. The total value of the issue is rupees 10 lakhs. The shares are issued for a period of 5 years, would be redeemed at the end of 5th year. The shares are to be redeemed at rupees 11 each. That means what? That means these preference shares are redeemable. These preference shares are redeemable and therefore they would be recorded. They would be recorded as a financial liability, strictly speaking. Okay. The shares are to be redeemed at 11 each. Matlab, I had issued them as 9% preference shares, par value 10 rupees, redeemed at 11. So therefore you would have an effective interest rate calculation that would normally happen in the case it was treated as a financial liability. At the end of year 3, that is on 31st March 20X4, the company finds that it has earned good returns than expected over the last 3 years and can make the redemption of preference shares early. To compensate the shareholders for 2 years of dividend which they need to forego, the company decides to redeem the shares at rupees 12 each instead of the original agreement of rupees 11. Instead of the original agreement of rupees 11. Comment on the impact of early. What is the question? 1 second. Comment on the impact of early conversion of preference shares at a premium on earnings for the year X3, X4 attributable to ordinary equity holders. Attributable to ordinary equity holders of ABC Limited for basic EPS. Ignore the EIR impact in the solution. So I gave you the EIR explanation, but what the question tells is ignore this entirely. So therefore, you can look at this. Ideally, if it was a financial instruments included, ₹10 to ₹11 का जो redemption है, this would have gone in your EIR because it would be treated as a financial liability. And this ₹11 to ₹12 at the time of conversion, this would also be a part of finance cost because it is treated as a financial liability. Okay, because they are redeemable. So ideally, this also would have gone to your finance cost. No impact would come in your net profit attributable to equity shareholders because this extra ₹1 is already deducted when you are calculating net profit after tax. But they have told us to ignore this. They have told us to ignore this, and they have said that early conversion is going to happen. So ordinarily you would redeem at 11, but now you are converting it at ₹12. You are converting it at ₹12. To redeem the shares, you are redeeming it at ₹12. So excess ₹1 into 1 lakh shares. Into 1 lakh shares, this is ₹1 lakh. This is the loss on early redemption. Loss on early redemption. Where are you going to take this? This loss on early redemption, you will ultimately take it to your net profit after tax minus loss on early redemption. That means you will deduct it separately. So this is going to be net profit after tax, whatever it is, minus loss on early redemption, 1 lakh. You will deduct it from here to arrive at net profit attributable. Comment on the impact of early conversion नहीं होता है. It has to be redemption. Okay. It is a redemption question. Okay. So therefore, this is what is going to be your answer. This is what is going to be your answer. Forget financial instruments. Treat it as it is. Okay. So NPAT minus loss on early redemption, 1 lakh gives you your net profit attributable to equity shares. Though ordinarily, if financial instruments was applicable, this 1 lakh would go and form a part of finance cost, which would already be deducted when you are calculating your net profit after tax. Okay. So no further reduction needed. Okay. See, if I have to talk about EIR impact, Jay, I will just summarize it for you. Okay. ₹10 redeemed at ₹11. This whole thing would form a part of my EIR adjustments, and this would go in your finance cost. There is no treatment required. You are further paying an extra amount of ₹1 lakh. ₹1 lakh excess paid. ₹1 lakh excess paid. This would also have gone to your finance cost. So would you again deduct it here? Answer is no, you would not have deducted it here. But the institute has given that ignore the EIR impact. So every year EIR impact hum pakadte, then every year 1, year 2, year 3, year 4, year 5, you would slowly move from ₹10 to ₹11, and then the redemption would happen in the 5th year. But here the redemption is happening at the end of 3rd year itself. So jo baki ka bacha hua hai, you would entirely write it off as finance cost. This excess amount that you are paying, you will take it as finance cost, and ultimately it would all be a deduction while arriving at net profit after tax. But they have told to ignore it. So we ignore it and do the calculation accordingly. Okay. So that takes care of this question. All right. Itna simple question nahi aayega. There are a lot of things that can be asked here. Okay. So we will proceed to do that part. We will proceed to do accordingly. Okay. It is more of a theoretical question, and that is why we will treat it as such. Okay. Okay. Now we move on to the next question, that is an entity has the following preference shares in issue at the end of 20x4. What it has? 5% redeemable non-cumulative preference shares. Redeemable hai, non-cumulative hai. These shares are classified as liabilities. They have given to you that it is a liability. During the year, a dividend was paid on 5% preference shares amounting to rupees 1 lakh. What are you going to do? They have already classified it as liabilities. Already classified it as liabilities means the dividend paid would be regarded as a finance cost. And therefore, are you going to make any adjustment to this dividend paid after net profit after tax? No. Finance cost already deducted while calculating net profit after tax. So you will not do any further adjustment. Matlab, you will not deduct it from NPAT. Why? Because it is already deducted. Okay? The next one, you are having increasing rate, cumulative, non-redeemable preference shares issued at a discount in 20x0 with a cumulative dividend rate from x5 of 10%. You should now be in a position to understand the effect of this. When were the shares issued? When were the shares issued? When were the shares issued? These shares were issued in 20x0. So x0, x1, x2, x3, x4. These 5 years, there is no dividend payment that will be made. From 20x5, 10% would be paid. So what did we study? Increasing rate. Bring it to the present value using the market rate dividend yield, and then you compute the imputed dividend. You compute the imputed dividend. It is a non-redeemable preference share. So therefore, this would be equity. This would be equity ideally. The accrual for the discount in the current year. Now this is again inconsistent. Accrual for the discount in the current year, ये नहीं लिखना चाहिए था. This would be accrual for the dividend using the effective interest method. Discount नहीं होगा, it would be dividend. Okay. We have seen increasing rate preferences, how we calculate the imputed preference dividend. Okay. So the accrual for the dividend in the current year calculated using the effective interest method amounted to, let us say, rupees 18,000. These shares are classified as equity. Amount is rupees 2 lakhs. Amount is rupees 2 lakhs. So therefore, now you tell me, what should I do? What should I do? Okay. So 1 second. These shares 2 lakhs. So 2 lakh is your shares. 2 lakhs into the rate, that gives you rupees 18,000. Rate क्या है अपने को पता नहीं. This 18,000 is the current year's preference dividend element. You remember in that example we used to calculate 5.11, 5.64. Those figures are corresponding to this 18,000. Those figures are corresponding to this 18,000. This 5.71, 6.11, 6.54 ke jagah, it is 18,000 here. What we used to do to this 5.71, I would deduct it from my net profit after tax to arrive at net profit attributable to preference shareholders. And therefore, what are you going to do with this 18,000? You will deduct it. You will deduct it. Why? Because this dividend is already included when I am going to issue the shares at a discount. When I'm going to issue the shares at a discount. So you are kind of back working to arrive at the preference dividend figures, to arrive at the preference dividend figures. थोड़ा सा अजीब लगता है because they've used accrual for discount. It has to be accrual for dividend. Another inconsistency that you can see is calculated using the effective interest method. Normally, equity and effective interest rate cannot exist. Classify it as a liability, take it as effective interest rate. The words that should have been used here is not effective interest method. They should have used the words market dividend yield, market dividend yield, and that would give you the consistency to this question. So if I have to actually modify the question, it would look like increasing rate, cumulative, non-redeemable preference shares issued at a discount with a cumulative dividend rate from 20x5 of 10%. These shares were issued at a discount to compensate the holders because dividend payments will not commence until 20x5. The accrual for the dividend in the current year calculated based on the market dividend yield amounted to say rupees 18,000. If these were the words which were used, then it would fall in line with the increasing rate preference shares concept that we just now studied. Here, somewhere they have kind of gone inconsistent, but we can give them the benefit of doubt and say that 18,000 has to be deducted. So we deduct 18,000. Next one. 8% non-redeemable, non-cumulative preference shares are there. At the beginning of the year, the entity had 1,08% preference shares outstanding. But at 30th June 20x4, it repurchased rupees 50,000 of these at a discount of 1,000. That means shares worth 50,000 you purchased for 49,000. There is a gain on repurchase. There is a gain on repurchase that is rupees 1,000. That is rupees 1,000. Where will this gain go? Well, you will adjust it. You are going to adjust it. This is an early redemption which is happening at a discount. This is an early redemption which is happening at a discount. Look at what is Institute's treatment. Early redemption premium usually taken to securities premium. Therefore, deduct the same while calculating net profit attributable to equity shareholders. Here it is happening at a discount. So the gain would have gone to the other equity. So you will add it to your net profit. Okay. Add to net profit after tax. Okay. Next one, 7% cumulative convertible preference shares converted in the current year. These were classified as equity until their conversion into ordinary shares at the beginning of the year. No dividend was accrued in respect of this year, although the previous year's dividend was paid immediately prior to conversion. मतलब हो गया, conversion से पहले मैंने dividend दे दिया. To induce the conversion, the terms of conversion were also amended, and these revised terms entitled the preference shareholders to an additional 100 ordinary shares on conversion with a fair value of rupees 300 nil. Okay. So you are getting ordinary shares additionally is equal to rupees 300 into 100. Rupees 300 into 100 shares. So that is equal to rupees 30,000. That is equal to rupees 30,000. But look at the treatment. Early conversion, it would already have been taken into finance cost is what is the Institute's way of interpreting, because there is no guidance in Companies Act. So we stick to this. Ideally, this should be the treatment. You first classify your instrument as an equity or liability. If it is a liability, it will go in finance cost regardless of whether converted or not. If it is equity, it would go in other equity regardless of whether converted or redeemed. Okay, so this should be the treatment. Institute follows this. That is the small inconsistency which is there. We solve according to that inconsistency. So this is what is your early conversion. Therefore, this would already have gone in your finance cost. So no adjustment. No adjustment. So what is going to be your adjustable items? Will one be adjusted? No. It is already finance cost. It will go in finance cost. Will 2 be adjusted? Yes. You will have to record that 18,000 rupees deduction. Will 3 be adjusted? Yes. 1,000 is a gain. Will 4 be adjusted? No. It will be regarded as a finance cost. So the profit after tax for the year 20x4 is 1,50,000. So what is going to be your net profit for equity shareholders? That will be calculated like 1,50,000 net profit after tax. Uske baad, what are you going to deduct? Well, you will deduct 18,000. This is your preference dividend. And then you will add gain on redemption. That is 1,000. You will add your gain on redemption. That is 1,000. So that comes to 1,33,000 rupees. That comes to 1,33,000 rupees. Jay Srivastav, premium payable at maturity. It depends. Ideally, it depends on how are you classifying your instrument. Ideally, it depends on how are you classifying your instrument. If you are classifying it as a liability, it will go and sit in your maturity, in your finance cost. Okay. But if you are treating it as equity, it goes in your other equity. You will have to deduct it from NPAT to arrive at net profit attributable to equity shareholders. Okay, so this is illustration 2. थोड़े बहुत inconsistencies हैं, मैं मना नहीं कर रहा हूँ, but broadly I think the institute has kind of tried to walk a fine balance to make you understand the concepts of Ind AS 33. Okay. So that concludes our discussion on the numerator part of the EPS calculation. So far we have covered basic EPS entirely. We discussed the numerator also. We discussed the denominator also. We discussed bonus issue. We discussed the rights issue also. And with that, we conclude our discussion on basic EPS in totality. We shall then move on to something known as diluted EPS. Yes. Can somebody tell me what is diluted EPS? What do you mean by diluted EPS? How many people are watching? And those who are watching, can you please tell me what do you understand by diluted EPS? Have you heard the term diluted EPS? If yes, what do you know about it? Sai Ram is asking non-cumulative preference share dividend, why it is not deducted. Sai Ram, these shares are already classified as liabilities. That means the dividend which you have paid now would already form a part of finance cost. That means the dividend already deducted in calculating net profit after tax. They have told that it is classified as liability. They have told that it is classified as liability, and therefore the dividend based on effective interest rate would be taken to your finance cost. So therefore you will not deduct it again. Okay. So Sairam, hope you understood that part. Yes. Diluted EPS क्या जानते हो आप? What do you know about diluted EPS? Okay. will be called as diluted EPS. Basic EPS excludes convertible. Vidula, I will be discussing that what will be the EPS if all the convertible securities were converted. We will discuss it as a part of my diluted EPS workings. Okay. So Tanushri is saying basic EPS excludes convertible debentures and preference shares, but in diluted EPS, we take the effect of these also. That's right. But I would like to, listen the words from a student who is in the CA final examination. Okay. So you have given me the answer, which is right. I'm not denying it, but I'm looking for a particular word which you can give to me. Okay. I'm looking for a particular word. It is there in your answer. Excludes convertible debentures and preferences. So ye kya hai? What are these instruments? Okay. Yes. So Sairam is saying decrease in share price. Vidula is saying called as diluted EPS. Okay. She's saying what will be the EPS if all the convertible securities were converted. I am getting right answers from you. Only thing is I just want to know the most crisp answer to diluted EPS. Weakening. Okay. All sab theek hai. It will be EPS considering the impact of potential shares in the capital structure. When you answer your questions, you have to look for these keywords. Okay, you have to look for these keywords. Okay, apne ko yaad rakhne chahiye, because what happens, it creates a different kind of impression on the examiner also. Okay, giving examples shows that we don't remember the keywords. Okay, it shows that you know the concept, but the keywords will enhance your understanding. Okay, so when I talk about potential shares, what all will come in potential shares? First one, it will include convertible debentures. It will include convertible preference shares. It can include options or warrants. It can include contingently issuable shares. Okay, any of these things can be included in that. Okay, so out of this, you have studied convertible debentures, you have studied convertible preference shares, you would have studied options and warrants, but what you would not have studied is contingently issuable shares. These items were there in AS20 also. But contingently issuable shares are a new guidance which is given in Ind AS 33. Very, very interesting guidance. Okay. So why do we do a calculation of diluted EPS? Why do we do the working of diluted EPS? Well, 1 second, please. Ye kya ho gaya? Yeah. Why do we do the calculation of diluted EPS? To give the worst possible scenario to the equity shareholders. To give the worst possible scenario, like many of you use the words weaken or decrease or reduction in EPS or diluted. Okay. All these answers are right. Okay. So what is the intention behind diluted EPS? It is the principle of conservatism. It is the principle of conservatism, number one. Number two is, we always are ridiculed, or we are always, people always tease us by saying that Well, what do auditors do? They come after the year is done and then they do the audit. So they are in effect something like post-mortem experts. After the things have gone wrong, they come and then they find out the errors in that. It is the normal thing that most of us go through. Okay, though audit is much more than that, but in this case, the diluted EPS is a forward-looking EPS. It is a forward-looking EPS. ये कोई post-mortem figure नहीं है. As many of you rightly have pointed out, giving the effect of possible conversions, giving the effect of possible exercise of options or warrants, when you calculate the EPS, that EPS will be my diluted EPS. That EPS will be my diluted EPS. So first thing we have to remember is, when I have to talk about diluted EPS, the diluted EPS is going to be net profit attributable to equity shareholders divided by weighted average number of equity. But wait a minute. This we have also seen somewhere. Yes, we have seen this in the basic EPS calculation. So when I have to calculate diluted EPS, my calculation will start with the basic EPS figure only. कहीं और से नहीं आएगा. It will start with the basic EPS figure, plus you will make adjustments to profits. Adjustments to profits on account of potential shares in the capital structure. अब उतना बड़ा लिखूंगा नहीं, but on account of potential equity shares in the capital structures being converted, plus increase in shares. Generally, it is going to be increase in shares on exercising the conversion options. Okay. The question is, how do I record this increase in shares? From which date? Suppose you have debentures in your capital structure. Suppose you have debentures, convertible debentures in your capital structure, or convertible preference shares, whatever you want. When you calculate diluted EPS, from which date are you going to take the conversion to have happened? Well, you would take the conversion to have happened, that is, potential shares would exist and it would be exercised. Right to potential shares would exist and it would be exercised from beginning of earliest reporting period or date of issue, whichever is later. Sir, what does it mean? See, suppose in your capital structure, right from starting, you have convertible debentures. That means what? Potential shares which are in those convertible debentures, they would also be deemed to exist right from the earliest reporting period, which is entire previous year plus entire current year. But suppose the convertible debentures were issued, let us assume on 1st of July, that means the convertible debentures came into existence now. They were not in existence earlier. And therefore, the potential shares in those convertible debentures, they would also come into existence now. They would also come into existence from 1st of July. They would be there only for a period of 9 months. You cannot take it right from the earliest reporting period, because what time pe the instruments only were not there which entitled me to potential equity shares. And therefore, the right to potential shares would exist and it would be exercised from the beginning of earliest period or the date of issue, whichever is later, whichever is later. तो ये हो गया कब से पकड़ना है, from when I have to take that into calculation. अभी from when हो गया, the next thing is till when. अरे भाई कब तक पकड़ेंगे potential shares. Right to potential shares exist till end of reporting period. यार, either you think that the convertible securities would exist right till the end of the year, if the facts are like that, so the potential shares thereon also would exist right till the end of the reporting period, or actual conversion, whichever is earlier. यार, दिस इज कॉमन सेंस ना. सी, कन्वर्टेबल डिबेंचर्स है आपके कैपिटल स्ट्रक्चर में, दे हैव नॉट येट बीन कन्वर्टेड, सो देयरफॉर यू विल रिकॉर्ड द पोटेंशियल शेयर्स नंबर, weighing it for time right up to the end of the reporting period. But suppose you had convertible debentures which were converted on 31st December itself. That means for the months of Jan, Feb, March, वो potential है ही नहीं. They are my actual shares now. They will go in my basic EPS calculation because they have been actually converted. And they will remain in my potential shares calculation only up till 31st December. Why? Because up till 31st December, they were not converted. So they remained potential. So therefore, whichever is earlier, or actual conversion, whichever is earlier. Okay. So that is one thing. Then the word used is dilutive. Sometimes it may so happen that when you do the calculation of diluted EPS, we'll check an example. The diluted EPS figure turns out to be less than the basic EPS figure. It turns out to be more than the basic EPS figure. Less hona chahiye. There must be a reduction in EPS, but sometimes it may result in a higher EPS, the dilution. If that is the case, then what would you do? You will not report that diluted EPS because it would be anti-dilutive. Remember, when we are giving this effect, keeping in mind the conservatism principle. मतलब my diluted EPS at all points of time should be less than the basic EPS. हाँ, एक control number का concept है. We'll be discussing it in the next class. But अभी के लिए you just remember diluted EPS must always be less than the basic EPS. तभी तो उसको diluted बोलते हैं. Okay. So that kind of takes care of our brief introduction about diluted EPS. Let us look at the theory part. Basic EPS we have done quite a bit. 1 second. Yes. So what do you mean by diluted EPS? A reduction in EPS or an increase in loss per share. What is anti-dilution? Increase in EPS or a reduction in loss per share, which could result from the assumption that convertible instruments are converted, options or warrants are exercised, or ordinary shares are issued upon satisfaction of specified conditions. So instruments will include debentures plus preference shares, options, warrants हो गया, and this is contingently issuable. Shares. Okay, I've shared this presentation with you. Should not be a problem for you. Potential ordinary share का मतलब क्या है? Financial instrument or other contract that may entitle its holder to ordinary shares. That is equity shares. Example, convertible preference shares, debentures, options, warrants, contingently issued shares, etc. Okay. So how are you going to compute your diluted EPS? Adjusted net profit or loss attributable to equity shareholders divided by adjusted weighted average number of equity shares outstanding during the period. Components में हम बाद में आएंगे. Okay, components में हम बाद में आएंगे. We are going to look at that in detail. So what are the steps for calculating diluted EPS? Compute the dilutive potential ordinary shares. Compute adjusted profit or loss for the period attributable to ordinary equity holders or parent entity. Compute adjusted weighted average number. Compute basic EPS, diluted EPS based on pre and post adjusted figures. That is 2 divided by 3. Okay. So that kind of takes care of my diluted EPS basic explanations. So we shall come to a question for our understanding. Okay, but all right. So now let us see this question. Entity A has in issue 25,000 4% debentures with a nominal value of ₹1. Okay. The debentures are convertible to ordinary shares at a rate of 1:1 at any time until 20x9. The entity's management receives a bonus based on 1% of profit before tax. Entity A's results for 20x2 showed a profit before tax of 80,000. Profit after tax of 64,000. A rate of tax of 20% is assumed. Calculate the earnings for the purpose of diluted EPS. Okay. So I am having net profit after tax 64,000. 64,000. All right. Now, because of the presence of potential shares, there will be a diluted EPS. Now, why will this dilutive EPS arise? Because I'm having those debentures. So if those debentures get converted to equity, what is going to happen is, see, diluted EPS is equal to net profit attributable to equity shareholders divided by weighted average number of equity shares plus any adjustment arising when the instruments would potentially be converted into equity shares. Matlab, now I'm having debentures. These debentures have potential shares. So assuming that the conversion happens, what are you going to add back? What are you going to add back? Well, you are going to add back the interest. You are going to add back the interest that you will be saving in the future. You are going to add back the interest that you are going to be saving in the future. So plus interest. But when you save the interest, you will also end up paying income tax on that. So therefore, this interest is going to be net of tax. Therefore, this interest is going to be net of tax. So add interest saved on conversion. Interest saved on conversion. What is the shares? 25,000, each share of ₹1 into 4%. 25,000 rupees into 4%. ये तो हो गया interest per year. But the moment you save the interest, you will end up paying higher tax. So into, what is the tax rate? 20%. So into 1 minus T. 1 minus 20%. So 25,000 into 4%, that gives you how much? That gives you, I think, 1,000. 1,000 into 80% gives you 800. 800. This gives you 800. हो गया खत्म? Is it all done, or is there anything else which happens on account of this? It's not over. You have to consider all the changes that could happen if the shares, if the conversion option were to be exercised. Now, interest went up because, interest went down, so my profits went up. And at the same time, the management receives a bonus based on 1% profit before tax. So, abhi my income has gone up because of savings on interest. As a result, my MD bonus also will come down. So, less increase in MD bonus. Now, what is the increase in MD bonus? 1% on net profit before tax. Yaar, my net profit went up by 1,000. Kaise 1,000? 25,000 into 4%. On that, the MD bonus increases by 1%. So 10 rupiah, 10 rupees. But the moment your MD bonus increases, your profit will fall down. Because the profit will fall down, your tax expense will fall down, and therefore increase in MD bonus also will be adjusted for tax. So the net impact on your profit is minus 8 rupees. And therefore, when you do the add less, you are going to get 64,792. This is net profit after tax for diluted EPS. Basically, you will not stop at just the conversion. You will have to look at further impacts that will happen to your earnings because of the conversion option that could have been exercised in the future. So it is a very, very forward-looking figure. Okay, it's not just going to be the case where jahan pe maine interest bacha diya and baat khatam. If interest changes, your tax will change. If interest and tax change, any expenditure which is linked to the net profit before tax, that also is going to change. And therefore, you will have to factor all of that in your calculation. Okay. So any doubt so far? Any doubt so far? No doubts? Not needed to have any doubts. बहुत ही छोटा सा. It's a very, very small topic that we have seen. Okay. All right. Fair enough. So what we shall do is we'll look at some questions and then come to some of these illustrations, and then we shall come to our discussions. Okay. Come to question number 16. For the time being, just forget क्या बोलते हैं उसको, financial instruments. Okay. आएगा question financial instruments का along with EPS. That time I will make you recollect it. But अभी के लिए just forget financial instruments. Okay. Darbhanga Limited gives you the following information. Compute diluted EPS. Net profit for the year is 2 crores. Number of equity shares outstanding is 40 lakhs. So the basic EPS is 5 rupees. Number of 11% convertible debentures of 100 each is 50,000. Each debenture convertible into 8 equity shares. Interest expense for the current year is 5,50,000. Tax savings relating to interest expenses 30%. Okay. So now let us check the answer. First thing, basic EPS. Net profit attributable to equity shareholders 2 crores. Weighted average number is 40 lakhs. So basic EPS is 5 rupees. To this net profit, when you are calculating impact of dilution, well, 2 crores, when the convertible debentures will be converted, you will take into consideration what? You will take into consideration the tax savings also that would happen on the interest that you are saving. So therefore, you are saving interest of 5,50,000, but you will end up paying the tax on those savings. So your net savings is 5,50,000 minus 1,65,000. So that gives you 3,85,000. So you will end up saving 3,85,000 net. And when the debentures are exercised, each debenture gives you 8 shares. So 50,000 into 8 is 4 lakhs. So therefore, 2 crore plus 3,85,000, 2 crore 3,85,000 divided by weighted average number 40 lakhs plus 4 lakhs. So 44 lakhs. So you divide 2 crore 3 by 44. So that gives you 4.63. Then you will have to compare it with the basic EPS. Basic EPS was 5. Diluted EPS is 4.63. Has it reduced? Yes. So therefore you can report it as the diluted EPS. Easy enough? Arey, yes or no? अपने को आसान लगा? Did we find it easy? Something you already know, right? Yes. Next one. Question number 16 ho gaya. Question 17, while calculating diluted EPS, effect is given to all potential ordinary shares that were outstanding during that period. Accordingly, calculate diluted EPS from the following. Net profit is given, number of equity shares outstanding is given, 8% convertible debentures is given, interest expense for the year and tax relating to interest expense. Just 1 minute, please. You can have a look here. Interest on debentures is equal to 1 lakh debentures into rupees 100 into 8%. So that should give you 8 lakhs. But what is your interest figure? Sir, it is only 6 lakhs. Sir, printing mistake. No, it's not a printing mistake. This interest figure of 6 lakhs indicates that debentures, therefore, debentures issued during the year, after a period of 9 months, 6 by 8. So that is 3 by 4. So after a period of 9 months. So keep that in mind. And then let us look at our calculation. Profit or loss attributable 85,50,000. This is basic EPS. We start from here. Basic EPS. 85,50,000. Number of equity shares outstanding, these are actual. So divided by 20 lakhs. So the basic EPS is 4.275. Now, if you are going to convert, so therefore your amount of interest expense will be 6 lakhs into 100 minus 30%. That is 4,20,000. Simple. Okay. But the number of shares that will arise on conversion, you cannot directly take. Each debenture is convertible into 10 equity shares. You cannot say 1 lakh debentures into 10 equity shares. You cannot say it like this. Instead, what are you going to do? Why I cannot say like this? Because my debentures were not present for the entire period. Sir, how do you know that? Well, my interest should have been 8 lakhs. It is only 6 lakhs. So therefore, they were present only for 3 quarters of the year. That means they were present only for 9 months. Okay. And accordingly, you will have to do the conversion also. So conversion will be 1 lakh debentures into 10 shares per debenture multiplied by 9 by 12. Multiplied by 9 by 12. So that gives you 7,50,000. So 85 plus 420. 85 plus 420. ये थोड़ा सा टाइपिंग मिस्टेक हो गया. 1 second. 89 lakhs 70,000 divided by 27 lakh 50,000. This figure is correct. Okay, this figure is right. 3.26. 3.26. All right. This figure is correct. So that takes care of question 17. From when have you to consider the potential shares? From the earliest reporting period or date of issue, whichever is later. Till when they would be considered potential? Till end of the reporting period or actual conversion, whichever is earlier. Whichever is earlier. Okay, so that takes care of question 17. Let us then move on to question number 18. Okay. Meghna, yes. Calculate the basic and diluted EPS of Meghna Limited from the following particulars. Equity shares as at the beginning of the financial year, 50 lakhs. Net profit for the year, 2 crores. Issue of shares for cash on 1st July, 10 lakh shares. This is fresh issue. Is it a rights issue? No, it's a normal issue. Okay, not a rights issue. Issue of bonus shares on 1st October, 1:5, as at the beginning of the year. That is 1 crore. That is 10 lakh shares. 1 second. Convertible debentures outstanding at the beginning of the year is equal to 10% debentures for rupees 1 crore. Face value rupees 10. Likha nahi hai. I'm just writing it for you. Conversion ratio 1 share for 1 convertible debenture. Company tax rate is 40%. Company tax rate is 40%. Do you want to try this out? Do you want to try this out right now? Yes. Do you want to try this out right now? Try this out, please. It's an interesting question. Don't check the answer. Answer mein something may be wrong. Okay. Calculate, please. I'm waiting for your answers. Two crores divided by number of shares. कितने थे? 50 lakhs. Into bonus ratio is 1:5. So bonus adjustment factor. Bonus adjustment factor 6/5 into 6/5. These shares were there for entire 12 months plus 10 lakh shares into 9/12. Well, the bonus is issued based on the shares at the beginning of the year. So the fresh issue is not getting entitled to the bonus. So we are not calculating the bonus on the fresh issue. Okay, it's based on the beginning of the year. So that is 10 lakh shares. So if I do this, I will be getting it as rupees 2 crores divided by 60 lakhs plus 7 lakh 50. So 67 lakh 50,000 shares. $2.96. $2.96. Okay. Then you move on to somebody calculate diluted EPS for me. Don't look at the answer in the solution sheet. वो answer गलत है. That answer is wrong. Okay. I will also tell you why it is wrong. This is the answer to the basic EPS. Then you proceed to diluted EPS. Diluted EPS starts where basic EPS ends. So this is 2 crore divided by 67 lakh 50,000 shares plus. Convertible debentures outstanding at the beginning of the year. So that is 1 crore into 10%, 1 minus T. Okay, so 1 crore into 10%. This is the rate of interest into 1 minus 40%. 1 minus 40%. This is the savings in tax. I mean savings in interest net of tax. Okay. So now what should be the number of shares that will come on account of conversion? If the debentures had to be converted, what would be the number of shares? Somebody please calculate and tell me. Somebody please calculate and tell me. Somebody please calculate and tell me. Bolo guys, after 9:40 there has been no communication. 9:37 was the last communication by Kumar Mangalam. Nice name. $79.5 lakhs. नहीं यार, how are you getting 79.5 lakhs? Achha, you are giving the total answer. Jay is giving the total answer. That's right. 79.5 lakhs is total. How did I get that? Well, see, I have debentures worth rupees 1 crore. Each debenture has a face value of rupees 10 per debenture. The conversion ratio is 1 share for 1 convertible debenture. So these are the number of debentures multiplied by 6 by 5. What is 6 by 5? Bonus adjustment. If you have convertible debentures in your capital structure, obviously those convertible debentures would also be subjected to getting the bonus shares. Yes or no? And therefore, I will multiply it by 6 by 5. I will multiply it by the bonus adjustment factor into 12 by 12. Into 12 by 12. So this is going to be 2 crores plus 1 crore into 10%, that is 10 lakhs. So that is 6 lakhs. So 2 crore 6 lakhs divided by, this is 1 crore by 10, that is 10 lakh rupees, the 10 lakh debentures convertible into 10 lakh shares into 6 by 5, that is 12 lakhs into 12 by 12, that is again 12 lakhs plus 6750. So that is 79 lakh 50,000 shares. So that gives you your EPS 2 crore 6 divided by 79 lakh 50,000. 2.59. You will compare this with the basic. Is it less? Yes. Then in that case, this is diluted. Sairam, it 10 lakhs is the basic conversion, but you will have to factor in the bonus also. Because bonus bhi to milega unko. So that also represents potential shares in the capital structure. Because it is already declared now. If it was not declared, you would not consider it. But now because it is declared, it will be included in the computation. So 79 lakh 50 will be the veins for diluted EPS. So that kind of takes care of the question. So if you look at the solution that is there, yeah. See, this part is right. This part is right. This is also right for basic EPS. For basic EPS, 67 lakh 50 is correct. But for diluted EPS, divided by 10, I'm not sure how we got this. It should be multiplied by. But this does not factor in the bonus. So bonus not included. Should it be included? Yes. When you are considering all the shares, you have to consider the bonus also. So bonus is not included. So this figure is wrong. And therefore, this figure also is wrong. Okay. It should be 79 lakh 50 as rightly pointed out by Jay. And diluted EPS will come to 2.59. 2.59. Okay. So that is the change that you will have to make in the solution. That is the change that you will have to make in the answer. All right. Debenture holders gets the bonus shares. Why not? See, we are talking about potential shares. Potential shares. Debenture holders have not converted. But if they had to convert, are there shares in the capital structure? Yes. Were they present right from the beginning? Yes. So if they had to convert, would they be entitled to bonus? Yes. Why? Because bonus is based on shares at the beginning. And therefore, would they get the bonus shares? Yes. And that is why when I do diluted EPS, I will take it as 12 lakhs in this question. Okay. Not 10 lakhs. Okay. The good part about EPS standard is there are no journal entries. The bad part of EPS standard is there are no journal entries. So both the good and the bad is that there are no journal entries. Journal entries hota tha, we would be a little more comfortable because kya hai apne ko, we get a lot of comfort with journal entries around us. But this is only numbers, right? So we will have to factor that into account. Okay. Okay. What I want you to do is, I want you to try out. So this I have done. I want you to try out question number 18 ho gaya. I want you to try out question number 19 also by yourselves. But in basic EPS, Kumar Mangalam is saying we have already considered the bonus. Beta, this bonus included is on existing share capital. Bonus included here is on potential shares, Kumar Mangalam. Okay. So you cannot say that they are the same bonus. It's not double effect. It's not a double effect. We have considered the bonus of 10 lakhs, not on the debentures, but that is considered in respect of the shares in issue. Yes, this 10 lakhs is calculated as, not this 10 lakhs, this is a fresh issue. Hai. This 50 lakhs is the number of shares I have in issue. So on this 50 lakhs, I will automatically get 10 lakh. वो तो actual है. That is actual. That's not potential. This is potential bonus. This is potential bonus. कोई double accounting नहीं हो रहा है. There is no double accounting. This is potential bonus shares. When I take the potential conversions into consideration, how can I ignore the bonus on such potential shares? I have to consider it. Yes or no? So therefore, there is no double accounting. The 10 lakh in 67 lakh 50 is actual issue. The 10 lakh in debentures is potential bonus shares. They are two different 10 lakhs. Okay. Kumar Mangalam, let me know if you have understood. Okay. And Sairam, hope you have also understood. So that takes care of that question. Okay. Question number 19. I want you to do this for homework. There is one important aspect that you have to take care in question number 19. Okay. Those of you who are able to do that without looking at the answer, I will be very happy, because that means you have understood bonus shares and diluted EPS very well. Those of you who are unable to get that, when you compare it with the answer that I have shared with you, you should be able to understand. But after that also, if you are not able to understand, let me know. I will discuss this on Tuesday. Okay. So that takes care of 18, 19. We move on to illustration 8 of your institute's questions. ABC has 10 lakh ordinary shares of rupee 1 each and 1000 rupees 100 convertible bonds issued at par, which are convertible into 20 ordinary shares on demand, all of which have been in issue for the entire reporting period. ABC Limited's share price is rupees 4.5 per share. Earnings for the period are rupees 5 lakhs. Tax rate is 21%. And calculate the basic EPS, earnings per incremental share for the convertible bonds as well as the diluted EPS. Okay. So basic EPS, simple it is, 5 lakhs divided by number of shares, 10 lakh shares. So that is equal to rupees 0.5 per share. rupees 0.5 per share. All right. Next one, when I start to calculate diluted EPS, it starts with basic EPS 5 lakhs plus my interest on debentures. So 1000 into 100. So that gives you 1 lakh into 10%, rupees 10,000 is the interest which I would be saving into 1 minus 21%. So that is the tax savings. That is the tax that is there, the tax impact. So interest net of tax savings divided by 10 lakh shares to the plus each is convertible into 20 ordinary shares. Each is convertible into 20 ordinary shares. Okay, so that gives you 20,000 shares. That gives you 20,000 shares. Okay, so now when you calculate the diluted EPS, that gives you how much? $0.498 per share. Incremental EPS क्या होता है? Incremental EPS, 1 second. EPS per incremental share. Yaar, what is the extra earnings that you are going to get on account of potential conversion? What is the extra shares that you are going to get on account of potential conversion? Which is basically this part. So this is rupees 7,900 divided by 20,000 shares. $0.395. $0.395 per share. Is this lower than this? Yes. So therefore, this is diluted. Yes. Have you understood this? Yes, all clear. Now see, look at this question. Presently, what is the holder of one debenture having? Debenture worth rupees 100. On conversion, he will get 20 shares into rupees 4.5. So that is shares worth rupees 90. Check this. Presently, his debentures are worth rupees 100. Matlab usko on redemption also he is going to get 100 rupees, no doubt about that. But if he converts it into shares, his total holdings will be worth rupees 90. So technically, it does not make sense for him to convert. He will not convert. But when we are computing diluted EPS, we do not look at whether the conversion will happen or not. What if it doesn't happen? What are the factors not leading to all those things? We are not interested right now. We are interested in computing the diluted EPS after factoring all the potential convertibility that is there surrounding the capital structure. Whether it is beneficial for the shareholder, whether it is beneficial for the company, all those things we are not concerned with. No subjectivity is involved. It's a plain, pure, objective calculation. You have shares of a potential. You have potential shares. Include them in diluted EPS. Don't go into other aspects. Okay, so that is something we had to take away from that. Illustration 8. Okay, this part I will leave it for homework. I will leave it for homework. Okay, please try it out. I have given you 2 questions for homework. You should be in a position to do that. Okay, you should be in a position to do that. Okay, next what we shall do is in the next class, we have quite a number of concepts to do. Please do these questions so that diluted EPS, your concept kind of gets cemented. In the next class, we will be doing diluted EPS in respect of options and warrants, which is a small concept, needs about half an hour. Then we will be doing something related to contingently issuable shares, for which I will need quite some time, okay, at least an hour or so to discuss. And then with that, that should, options are there. Then EPS with financial instruments. That should take another hour or so for our discussion, because this question I have already done. So we should be in a position to discuss EPS with financial instruments. We should be in a position to discuss options, and that kind of would conclude the chapter on Tuesday. It will be faster if you are braced with the understanding of diluted EPS. If you already know options, you have studied, if possible. I mean, it's a difficult ask for you, but if possible, what you have studied in AS20 in your intermediate, please try to revise and come for the session on Tuesday. So you will be in a position to understand faster. And if you understand faster, we can move faster. It is a repetitive concept. I don't want to take a lot of time for that and end up with lesser time for financial instruments or contingently issuable shares. I want to take more time for those topics. Okay. So let me know if you can revise that. Then we shall continue. And yeah, last one is holding and subsidiary. In the event of holding and subsidiary, EPS in the case of consolidated financials. How we are going to, it's hardly 10 to 15 minutes. Okay. So take care. Anybody has any doubts? Finally, anybody has any doubts, any difficulty, anything to ask, anything to criticize, comment, or suggest? I'm open to anything. Am I too fast, too slow, quite boring, or whatever is there? Just please share your feedback. Please also share your feedback to the institute, so they can accordingly, guide us in how to make the topics more understandable to you. Okay. All these things are there written form, so I'm not making you write anything. Okay. And many questions I have shared the notes also with you. So that is the reason I'm not giving you much in writing. Okay. Done? Any doubts? Anyone? किसी के पास कोई डाउट नहीं है. I take it that you have all understood. So thank you everyone, and see you guys on Tuesday morning. Revise what is done. Okay. Thank you.